Good morning, everyone. My name is David Scherer. I'm co-CEO, co-founder of Origin Investments. Super excited to be with you this morning, and my partner in crime, Dave Welk. Dave Welk's our managing director of acquisitions. He's been with us since 2011, so for 11 years. He runs our acquisitions nationwide and also our operations in his region: Raleigh, Charlotte, Charleston, Atlanta. And so Dave's been prolific in terms of sourcing. He's going to cover our deal portion. So the format of this will be, I'm going to go over market conditions. I'm going to try to answer some of your questions. We had about 40 questions that were sent in prior. Thank you so much for sending those in. And I would just say that there are generally three themes. One is around interest rates. The other is around Hurricane Ian and insurance. And the other is around recessions, what that's going to mean if there's a recession relative to rents and asset valuations. And so I'm going to cover all three of those in my remarks. And then, of course, you can always ask more questions. It's designed to be interactive. And so if you feel like you have additional questions in those areas, just go to the Q&A box and we'll answer those live questions. Typically, we try to do about 30 minutes of presentation and 30 minutes of Q&A. My guess is this is going to skew a little bit longer on the presentation because I want to get into a little bit more detail with some of the questions you've asked. So with that, let's get started. And I'm going to target around 15 minutes. Dave Welk, if you find that I'm going way over, just literally give me a little, a ding, 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 like I need to cut it a little bit shorter. And Dave, as an aside, I hope that your presentation is better than your fantasy football performance. And I do expect full payment, Bavette's dinner. Thank you. All right. So risk management. One of the things that we've touted, we've been in business since 2007. If you think about Origin, we started out in the Great Recession. And so we started out buying distressed assets from banks, foreclosures, short sales, bankruptcies, et cetera. And that was, a 3 to 5 year period. We did very, very well in that period. But the underpinnings of Origin is always about risk management. If you've been to these webinars in the past, I say something a lot, which is protect and grow. We want to protect and grow. And that starts with the fact that Michael and I, my partner and co-founder at Origin, we're the largest investors in all of our funds. And we're the largest investors at Origin. We want to protect and grow our capital and, of course, our investment partners' capital. And we've been successful doing both. So let's start with interest rates, and we'll go straight down. But before I start on interest rates, one of the reasons, when you think about risk management is really the decisions you make every day in every market environment. You don't wait until, the market turns, the Fed's raising rates, there's inflation. There's always risks in the world, but people tend to focus on risk management when they feel less safe, less secure. It's our job as a manager to feel that way all the time. And so, we weren't chasing deals last year or even the year before that when the valuations got crazy. We didn't buy anything in the cash market. In fact, we sold a lot, and we moved to development, which I'll get into, which is much more, in my opinion, protected. So risk management really starts with, what do you pay for assets and what don't you do? And I just want to stress that for a second, because if you look at this fund, no assets were acquired in the last 2 years that were core, stabilized, rented assets. And that was by design. We felt like everything was priced to perfection, and a lot of markets overpriced. The assets that we own, the depreciable assets that we own, one's in Chicago, one's in Houston, one's in Austin, and Dave will get to that. Those were all purchased well before the run-up in valuations at capitalization rates in the 4.5 to 5 range. They went all the way down to 3.2. We didn't chase those assets. We didn't acquire them. These are decisions made. It matters. The price you pay matters. So interest rates, I'm going to spend a little bit more time on interest rates. If you are an investor in our fund, the IncomePlus Fund. And on this webinar, most of you are investors, and some of you are interested in joining the fund. Of course, it's always open for investment. It's an open-ended fund. But if you are an investor, you received your distribution and your monthly update. And in that monthly update was an update on our interest rate hedging strategy. And I'm going to go into detail here because I think it actually matters. When we say we're a risk manager, it means we identify risk and then we act on that. We actually make decisions that mitigate risk. And so this year, our credit committee identified, and Dave's on that committee, I'm on that committee, my partner Michael, Tom Bronny's on that committee, Mark Turner, many of you have seen on the webinars, he's on that committee. In January of this year, we identified interest rate increases as a significant risk to this fund and other funds that we had. And there's a lot of debt that we actually can't hedge unless we use options or swaptions or swaps because it's on development. You can't hedge debt before you have a loan. You can't hedge debt into long-term fixed debt until you have cash flows. That's what banks and insurance companies want to see when they make long-term fixed rate loans. And so what do? In this fund, we have $340 million of debt, and I'll get to this on the roll-up. But what that means is we're capitalized about 1-to-1 debt to equity, very conservatively, actually. It's just over a $320 million fund in terms of equity. It has about that much in debt. 67% of that debt is hedged. So if you have concerns about interest rates going up, I'm telling you, we've hedged 67% of the debt. And that's a combination of swaps, swaptions, profits that we've generated on swaption sales that now sits as cash, and fixed rate debt on loans. But the big picture is 67% of our debt is hedged. And in terms of what we've done to date, we have a $6.1 million profit on our first swaptions that were dedicated to this fund that we sold. And so we bought them at about a 1.8 risk-free interest rate in the 10-year note, and we sold them right around 3.2. And we realized that gain, 6.1 million. That was on a $3.8 million investment. We were returned 9.9 million. The net is 6.1. So that sits as cash against future interest rate increases. And then we went back and hedged more at around a 2.8% risk-free rate. And that was before the run-up of the last 2 months. And so between realized and unrealized gains, this fund has generated $8.5 million in profits from swaps and swaptions. And to put that in perspective, this fund is roughly a $300 million fund. You're talking about a 3% annualized return just from our hedging strategies on this fund. And so you could ask the question, well, why would you do swaps and swaptions? You're really a real estate manager. That sounds esoteric. The reason is we think we're really good at what we do. We think that we have real competitive advantages in sourcing, in operations, and risk management. And because of that, we want to hedge the things we can't control. We can't control where interest rates are going. If you ask me my opinion on where interest rates are going, I actually don't know. I can make a very strong case that they should go down because the recession is coming and typically long-term rates follow. I can make a strong case that they can keep going up because the Fed needs to raise rates. Inflation will not be held in check. I don't know, and candidly, no one knows. And that's why volatility is high in the public markets. You see it. But what we're going to do is hedge what we can't control and continue to do the things we do well. Because I'll get to the opportunity section at the end of my presentation, but I actually think this environment will set up to be an incredible environment for this fund and for our investment strategies. But we may have to make sure that we're playing offense, and that's why we hedge, and that's why we risk manage in the way that we do. So going back to the big picture, housing demand, I'm going down to the second area of this slide. Housing demand and this is what's really interesting. Housing demand remains incredibly strong in the US, and that's on a long-term basis. Now, remember, this is a long-term fund, right? So you're going to have, you could say, well, no, Dave, I saw on CNBC today that rental demand is actually flat month over month, and that runs counter to what you're saying. That's true on a month-to-month basis, that it is flat. But I'm talking about long-term. This is a long-term fund. And long-term, the US is undersupplied by about 4 million homes. That's both rentals and for sale. And that really started all the way back in the Great Recession, 2011, 2012. We stopped building. The financial markets seized up. The builders couldn't get debt. The consumer didn't have equity to buy these homes. And we've never caught up. You know, the US is actually a positive population growth country. We grow population. And we need to keep up with the population growth. And there was a period of, 2, 3, 4 years where there just wasn't enough supply, and we've never caught up. The other thing I would add is the areas of the country that we invest are the areas with the greatest imbalances. Because if you think about cities like Austin or Atlanta or Denver or Charlotte or Nashville, these are the cities with enormous population growth. Phoenix, Raleigh, Atlanta, Tampa Bay, Orlando, Colorado Springs. You can keep going, but not only are we undersupplied for housing, but the cities that we're in are the ones that need it the most because they're growing the fastest, and there's imbalances, just as there are imbalances in the labor market. Some industries have enough labor and some don't. So that's true of housing too. The last thing I'm going to speak to is capital markets activity, which really addresses the question about what's happening. Are we going into a recession? And if so, what is that going to mean to rents, and what will that mean to asset valuations? And the thing that I'll tell you, and this goes back to my first point about risk management. So to answer your question, the capital markets, there's been, you see this in the residential real estate market too, there hasn't been much activity in terms of sales because the sellers want last year's prices and the buyers aren't willing or able to pay last year's prices because interest rates are higher, the cost of assets are very high. Some interesting things have happened in terms of demand for rentals because the for sale housing market got so ahead of itself. So to buy a home, if you were, for example, in Austin, just to hold it up as an example, in Austin, you saw enormous appreciation for the last 2 to 3 years. And then with interest rates going so much higher, the mortgage was on a 30-year was about 3%. Now it's about 6.5%. But you're also paying much, much more for the home. Yes, your income has gone up, and that has happened, but not nearly as fast as the affordability of homes and the interest rates. So what's wound up happening is, as a percentage of your income in Austin, it used to be around 30%, meaning your mortgage, your insurance, your property taxes. And now it's more like 42%. And that's not really sustainable. And so you see this lack of transactions in the residential market. And what we see is there's just a lot more people that have to rent because they actually can't afford a home. They can't afford a home in Denver. They can't afford a home in Austin, et cetera. And that's really helped our demand. There's millions of people that are what we would call trapped renters right now until the residential market rebalances. And it can rebalance through higher wages, much higher wages, or through interest rates going down, or through prices of residential homes going down. Like something has to change. But the net is our demand does go up, and we're seeing that. In terms of rents, I can tell you that our own machine learning and AI, which we pay very close attention to because it's been so incredibly predictive over the last 2 years, we, in January and February of this year, started looking at AI that predicted, our AI predicted very strong rent growth in Q1 and 2, flattening rent growth in Q3, and slightly negative rent growth in Q4. Now, I know that sounds scary, but when rents go up 10 to 15% 2 years in a row, for it to go flat or slightly negative is actually probably a healthy thing. But what I'm trying to tell you is what you see unfolding now in the data is what we expected. And not only is it what we expected, it's how we've been underwriting all year. So all the deals that we approve are through the lens of a machine learning, artificial intelligence rent growth modeling that has predicted slowing the negative rent growth in Q3, 4, and throughout 2023. Our machine learning has also been predicting for well over a year that there's going to be a recession in the end of this year and into next year. And we've been following that modeling as well. The last thing I'll say is in terms of capitalization rates, I would characterize those as the multiples on EBITDA or the multiples on our NOI, net operating income. Those have gone up considerably, meaning at the beginning of this year, the multiples on quality real estate, multifamily rental real estate in our markets were somewhere between 28 to 30 times. And so that was an abnormally high multiple because of such low interest rates. And what we've seen this year is the multiple's gone down, really around 25 times. So in other words, a 4 cap. Previously, it was a 3.2, 3.3 cap. So what does that mean to this fund? Well, a couple things. Again, when multiples were 30, we never reflected that in our NAV of this fund. We never pursued deals at those levels either. In fact, Dave Welk and Tom Briney and Mark Turner and myself and my partner Michael, we sat in committee and said, I don't care where this is trading, we're not going to look at a deal below a 3.75 cap, and we're not going to value the fund below that. We're just not doing it. And so when the NAV, what I'm telling you is the NAV was greatly undervalued in this fund relative to where stuff was trading because we didn't buy into the hysteria. The other thing I tell you is in development and development pref, we then drift our cap rate. So forget about the stuff we're underwriting now. Even the stuff we underwrote last year, we would start at a 3.8 or a 3.9 cap, and we would drift it, the capitalization rate, 10% over the period. And so you were winding up at a 4.3, at a 4.4, at a 4.5. We had a lot of cushion. We still do. And I'm going to go through an analysis because we have a lot of questions about stress testing, and we'll do that in a moment. All right, I'm going to spend less time on the other slides, I promise. Next slide, please. I think this slide's pretty important. What we've done here is on the far right is your traditional stock and bond portfolio. That's 60% stock, 40% bonds. This portfolio has been very unsuccessful. It hasn't achieved its goals this year. Typically, stocks and bonds haven't correlated over the last 10 years, meaning if stocks are going up, bond yields tend to go up, meaning the bond values go down, and vice versa. And so they don't correlate. And that's a good thing in a portfolio. You don't want your portfolio to correlate. You want it to smooth itself, hedge itself, if you will. That hasn't happened this year, right? The yields have gone up at the same time that the stock market has gone down. In fact, the stock market has gone down because the yields are going up and all the discount rates are going up on assets. So the year-to-date return on the traditional portfolio is around down 11%. The standard deviation, which is the volatility of that portfolio, 4.5%. You want to have a lower standard deviation. That's what you're looking for in a portfolio, less volatility. It's associated with risk. And the Sharpe ratio is just the relationship between the returns of negative 10.7 and 4.5. 10.7 is the numerator, 4.5 is the denominator. It's just math. So on the left, right next to it, we've subbed out the 60-40 stock and bond portfolio and inserted the IncomePlus Fund at 20% of that portfolio. 50-30-20, 50% stocks, 30% bonds, 20% IncomePlus. And you'll see year-to-date return goes up. It's still down, but it's down 7.4. Interesting enough, the standard deviation also goes down, which is what you're looking for. So now you're making more return, or in this case, you're losing less, but you're also taking less risk as measured by a lower standard deviation of that combined portfolio. And the Sharpe ratio, again, is just the math. It's the relationship between the two. And on the left, you see that you wind up with a 31% higher return, 17% lower standard deviation, and 104% higher Sharpe ratio. I mean, typically in portfolio construction, you're trying to increase your Sharpe ratio by 5 or 10%. Like that's a really big jump. So to see something that's over 100% is, I've never seen anything like it. And that should actually make a little bit of sense. I mean, you hear about how real estate is a hedge for inflation, and you're actually seeing it play out in real time. You know, first of all, it's a hard asset. So think about a multifamily building as an amalgamation of inputs. It has lumber in it, it has copper in it, it has steel in it, it has gypsum in it, it has drywall in it. As those costs go up and as the labor costs go up, if you have a built building, you're accumulating value because it's more expensive to replicate what you have. The other thing you have with multifamily is the ability to reset rents. Typically, that's done every 12 months. And we've been able to reset rents at 8%, 10%, 12%, 15% higher for the last year, year and a half, 2 years. That's an enormous driver of value. And if you think about the CPI, which everyone is focused on now, 20% of the CPI is the cost of housing, and the cost of housing is determined in CPI by the cost of rents. So if you see that the CPI is going up a lot and it's cost of rent driven, it's pretty good that you're in this fund. I mean, that actually is helping you. That's directly driving your EBITDA or your NOI higher. Next slide, please. So here is your portfolio as it stands today: 321 million of NAV, 11.34 of net asset value per unit. I mentioned before the leverage ratio when we talked about interest rate hedging, 52%. That generally means that we're hedged 1-to-1, meaning we have 1 unit of equity for every 1 unit of debt. Pretty conservative. 5.6% distribution yield. And then we juxtapose the projected with the current. And what we're trying to tell you here is where we really see the opportunities in the next 12 months, which is in preferred equity. Preferred equity, and I'll get into how much cushion it has, but it has a tremendous amount of safety. And the rates that we're getting now are plus or minus 14%. We really like the risk return of both the safety and the high returns that we're getting. And a lot of this is because the debt markets, which were largely fueled by debt funds, who essentially make loans and then they splice them into A/B note structures and they securitize the A's into what's called a CLO market. That market is really dried up. And so the debt funds are not very active. And the banks have seen that and they've pulled back their amount they'll lend. And that's really opened up an opportunity for our preferred equity, which we can start to do pref at 55, 58, 60%, go up to 75, very protected, meaning you've got 25% equity ahead of you as first loss, but still get 14%. We like that risk return a lot in this environment. And obviously you're well outpacing inflation, even if it stays at 8%, which I don't anticipate it will, but if it did, you're still outpacing that quite a bit in a protected position. So we would fully expect this portfolio to look like the portfolio on the right if you're looking at the end of this year. The only reason this would change would be if some of these deals get delayed. I will say that because of disruption in the capital markets, deals are harder to actually close than they have been in the past. We've seen this. This isn't the first rodeo that we've been through. We've been doing this quite a while, but there are cycles where it's harder to close deals. And this is definitely one of those cycles right now. Next slide, please. So I'm going to talk a little bit about preferred equity stress testing because we did have a couple questions. And, before I start, I do want to say that if you're talking to a manager, or any manager is explaining their strategy, and they're explaining a strategy that sounds like no matter what happens, we can never lose money, please don't invest with that manager, because either that manager is lying to you or that manager doesn't understand the risk themselves. There is no free lunch in investing. You take risks to make a return. And typically, if you take more risk, you make more return. What we've decided to do in this fund, and have for the last 2 to 3 years, is position it very defensively. And, I was really proud of how much the fund made last year because we were positioned defensively. So to make north of 20% and be positioned defensively, I thought was a really good thing that we did. This year, so far, we're up about 7%, tracking our goal of getting to 10 to 12%, still confident in that goal, but positioned defensively. So let's take a deal. And the reason I chose PDD Central Park is this is a deal that isn't our highest margin deal. I didn't cherry pick a deal and say, oh, I'm going to show you a deal that's our best deal. So look at, this is kind of our average deal over the last 12 to 18 months. And in addition to that, this deal is earning an 11.5% rate of return. And right now, I told you, if you were listening, right now we're getting 14. So you say, wow, this is 11.5, now we're getting 14. Yeah, but again, this deal was done, that was the right price at the time. That was with the risk-free rate 200 basis points lower, right? And it was an entirely different time. So let's go through this deal. PDG Central Park, it's in Stapleton, great market, Denver area. This is a partner we've already done a deal with that we value very much. So like no issues with the market, no issues with the developer. So let's start doing some stress tests on this deal. And so the pref and accrual, the return on cost in a mild recession. Remember I said that our AI and machine learning started to predict a mild recession a year ago, and we've adopted that. And basically what that means is we're lowering our starting rents. And so if we adopt the mild recession model and overlay it into PDG, you wind up with a return on cost of 5.24. And what that means is you're building to a stabilized cap rate of 5.24. Right now in this market, I would say the cap rate is plus or minus 4. Okay, so what am I really saying? In a mild recession, you've got about a 30% cushion. So I'm not sitting here as a manager saying there's no way you'll ever lose money in this deal, because like I said before, if I'm saying that, you shouldn't trust me. I'm saying you have a 30% cushion today, and in exchange for that cushion of 30%, you're getting 11.5%. That's what's happening here. Now, if we start to stress this more, we say, okay, well, what if it's not mild? What if it's an extreme recession? In an extreme recession, our AI is predicting $316 in lower rent. What happens then? And what happens then is our return on cost goes from a 5.24 to a 4.71. At a 4.71, you've still got roughly an 18% cushion, and so on. And I can share all this analysis. We can look at this 1,000 ways. But just know, every question you ask, we've covered. We talk about every week. We understand the risk return of it, and we're transparent. If you want to have this analysis, I'm happy to have investment management send you this analysis. I mentioned, and I was remiss, I mentioned insurance and Ian, because we got a lot of questions on that. So first of all, there are no assets in our portfolio that were affected by the hurricane directly. So no damage, that's not the issue. The real issue is insurance companies are in the business of making money, and now they're going to raise all their rates, right? You're going to have some probably that are going to go bankrupt, the smaller ones, the ones that, some reinsurance companies probably will too. There'll be less competition. The ones that are left will charge more. And so we have to model for that. Now, luckily, we have been, we again, we're always conservative. And in our underwriting, we've already in Florida been underwriting, $800 a unit. Well, that's not where it was. It was more like $650. So we're taking a really deep dive into insurance right now because we believe that the rates are going to go up and that, the growth rate is also going to go up. And we want to make sure that, we're long-term holders. We want to make sure that in years 3, 4, 5, 6, 7, 8, 9, we're not under budgeting in our models insurance, because that's the real risk to everyone is the insurance cost. We have no damage to our assets or developments in this fund. Next slide, please. So I mentioned our year-to-date return, 7.3. As I mentioned also in 2021, our defensively positioned portfolio still made 21.2. That's what you get in this fund, is you get appreciation because it's not all pref. We actually own actual assets too. So you have an upside tail, especially in the developments, by the way. Our developments are very high margin deals that are moving through, and even in a recessionary environment still have margin that'll be accretive to this fund. Dave will go over that in a moment. But it's also defensively positioned, and that's what I'm trying to convey in terms of the capital structure, the return on cost, what I just did with PDG Central Park. And then you have tax efficiency, and that's really important. We have a subsidiary REIT, which reduces your dividends by 20%. But then we also have depreciation, which offsets the NOI and the gains. So the idea here is if you don't sell your share, you're really not paying taxes. And that's a big consideration. We're all taxed investors. So if you're comparing IncomePlus to a bond fund, if you will, that's ordinary income, and you're going to pay it every year. So whatever your ordinary rate is, you need to equalize this return for that one. Next slide, please. So new opportunities, and I love this picture. This was actually taken last week. We have 3 developments in Colorado Springs for our QOZ funds that are just thriving. So if you happen to be in that fund, feel very good about our basis and what's happening there. But Dave and I, and Dave will speak in a moment, there's an enormous opportunity right now in K-series bonds. Those are publicly traded bonds. They're capitalized with very short-term debt. The power that you have at Origin is we see everything. Like if it's in multifamily, we see it all. We see the public bond part of it. That's the Freddie Mac K-series fund. We see preferred equity. We see equity deals themselves. We see development. We see everything. And the thing I'm zeroed in on right now is the K-series bonds. They're the ones that are repricing, and they're repricing because the public markets, the volatility there is pulling them in. And that's where you're going to see, in my opinion, the real opportunity in the next, tomorrow to next 2 months, 3 months, 4 months. Looking out into the future, I think in the cash market, there's a tremendous amount of assets, multifamily buildings that were purchased at cap rates that aren't realistic last year. Like I said, we sold a lot of them for funds where it was appropriate. If you're in Fund 3, for example, we sold virtually the whole portfolio. And what's going to happen in my opinion, on that side is if there is a recession and if there is slowing rent growth, and if interest rates do stay high, I think you're going to see real opportunities in distress. And this fund will be the fund that takes advantage of it. We will buy direct assets. Remember what we didn't do. We didn't buy assets when there was a mania. We didn't chase. We were patient. But there will be a time to buy direct assets. And in my opinion, it'll be 12 months, 18 months. Most of the debt on the assets acquired in 2021 was bridge debt. It was 2 to 3 year debt. Those should be coming due mid next year into 2024. And, I don't know the future. I don't know where interest rates are. I don't know where the economy is. I'm just saying there's a probability that there will be a real opportunity and we will be there to seize it. We are plugged into all the right places to take advantage, and this will be the fund that does it. And Origin is really experienced in that market. That's how we were born. That was the first 4 to 5 years of our company. We know how to operate in that environment. Dave, I'm going to hand it to you. I'm way over, sorry.
So on the next slide, we'll cover here PDG Charlotte. This is a 320 unit ground up project in the Sylvan Heights neighborhood of Nashville. Good to highlight this one because this was actually the fund's first build to core investment. Some of the highlights on this slide, we're using moderate leverage here at 66% loan to cost. And we have pretty strong return on cost margins here. Dave touched on the sensitivities regarding our forecast for extreme and moderate recessions. That's what's shown here on the return on cost. So low to mid 5% range as a downside, frankly, feels really strong given we're showing some negative rent growth when we're calculating those return on costs to get to that number. The next slide shows our current status of the project. Recently installed underground utilities and construction on the 7-level parking deck was completed over the second quarter. And in July, we commenced vertical construction on building A, which includes the majority of the common area amenities for the project. We did have some unforeseen subterranean rock that we encountered, which delayed our site work in building B for a bit. But overall, the project does remain on schedule because we were able to reconfigure and prioritize one of the other buildings so that we could sequence work on building B. Move-ins on this project are still slated for the third quarter of 2023. On our next project, we'll highlight Linden House. Linden House is a 295 unit Class A project, ground up project in the Bartram Park neighborhood of Jacksonville. It's about 25 minutes southeast of downtown Jacksonville, on the border of Duval and St. John counties. Similar to PG, we've got a moderate leverage that we're employing here of 64%, and even stronger return on costs, and under the extreme and moderate recessionary forecasts here in the mid to high 5% range. As Dave mentioned previously, happy to report no damage here was sustained at the site due to the events from Hurricane Ian. But the next slide will show us, today kind of where we sit. So you'll see that framing's underway across the entire site. Plumbing, electrical rough-ins are underway, and we've installed some of the fire protection pipes and primary electrical conduit lines. So things continue to move on pretty well here. The next slide will cover the portfolio highlights for the preferred equity segment of the fund. And really proud of the team's work across the country over the past really 12 to 18 months to create this really well-diversified portfolio. So 18 different investments across 12 markets and almost 190 million of equity deployed. I'm not going to spend much time talking about the protection benefits of this portfolio. I think Dave covered it quite well. But the summary of this is that we're right around a 13% target yield on this portfolio, and we've got a 1.4 equity multiple floor. So when you layer in the floor and the preferential treatment of our position on these investments, we're pretty excited about going into we think we're well positioned going into any potential headwinds over the next 12 to 24 months. One thing I'll note here, or two things I'll note. One, we actually think we're going to see an increase in deal flow in this space over the next couple of years. Dave touched on this a little bit, but really a big result of this is due to the fact that a lot of senior lenders are pulling back in their proceeds. And so developers are looking to fill that portion of the capital stack because they're no longer getting 65, even 60% loan to cost. So we're being asked to come in and sit between, basically make up that difference. So moving down in the risk spectrum, the capital stack, at the same rate of return feels like a very good place to be. But we're actually also reducing the top portion, our riskiest portion of the capital stack, meaning we're no longer necessarily sitting at 85. We're bringing that down as well. So a much more protected position within the stack. And as Dave indicated previously and highlighted the PDG Central Park project, we were at a mid 11 on that deal, and we've moved up our coupon to 14. So we're taking a more conservative position to stack at a higher rate of return. Feels quite good at the moment. Next slide, we'll go into, we'll jump over this one and jump into Novi Concord and talk about a particular deal here in my backyard of Charlotte. And this project is our first in partnership with the Lansing Melbourne group known as LMG. This will be a best-in-class project in downtown Concord, which is a northwest suburban community of Charlotte. This is 3 different buildings totaling 304 units, built across a variety of different parking structures, and one of which we'll see here on the next slide, is actually connected to a city-owned parking deck. And you can see that this is known as Novi Flats. So this has moved along furthest in the construction process. The foundations, as you can see on the left here, for Novi Rise and Novi Lofts are underway, still on schedule to have first units delivering in mid of 23. But a couple things we really like about this deal, in addition to our partner who we're looking to develop more in the suburban Charlotte market and more public-private partnerships, is the fact that we do have a great partnership with the town of Concord, in that we're utilizing their parking structures for free. They've given us those on a long-term parking lease. They effectively gave us the land at a 0 land basis. And then we have a tax abatement for 10 years on this project. So lots of additional cushion in this deal, economically, in addition to all the other elements that we focused on previously. Next slide, we'll jump into Haven at Mansfield. And I think this is my last one. And sorry for moving so quickly. I'm just trying to make up a little bit of ground. Haven at Mansfield is the last deal we'll cover in the prep pipeline. This is one of our several of our partnerships with Texas-based Geffen. This project's located in southwest, kind of central Dallas-Fort Worth Metroplex. Great submarket of Mansfield, great schools, actually has some real barriers to entry in this market, which is unique for Dallas-Fort Worth. On the next slide, we'll see construction progresses on schedule, within budget. All the buildings have been constructed, and we're finishing up the interior work. You can see that one of the examples of the kitchen interior that we're finishing up the drywalling and millwork on. And the lower right picture is we're completing some work on the pool and common area, and expect to deliver our first units really around the end of this year and start leasing early next. Lastly, we'll cover the pipeline for the fund here in terms of what we have we're working on currently. We've got about 6 deals totaling $81 million of equity that we've circled in the pipeline. Of the 81 million shown, we've got 50 million plus or minus are under our control and in due diligence, and we expect to close in the coming months. And as you can see from the dots on the map, although Phoenix is not represented, but again, we continue to diversify our portfolio across the country in high growth markets, including Charlotte and Dallas and Austin as well. So proud again of the work the team has done, and we do believe we'll see more and more opportunities kind of to serve really more of a rescue position going forward. So that is it for me. Dave, I think we've got at least 10 minutes of Q&A to get to, and I think we'll probably go longer than that, but I'll kick it back to you.
Dave, thanks for getting us back on track. That was amazing. All right, so I'm going to answer 2 questions because I think they're related. One is anonymous. The question is, why aren't you investing more into common equity versus preferred in the IncomePlus Fund? And the second just came in, also anonymous. It says, seems like firms like Blackstone's BREIT and CrowdStreet have been taking a lot of equity in the last few years. Any sense on how their projects will perform given a likely recession, et cetera? So the reason they're interrelated is, again, we're very cautious. We're very defensively positioned investors and this fund itself. And I've tried to stress that. These are decisions we've made 3 years ago, 2 years ago, last year, this year, our hedging strategies, all of it. Dave started to touch on this a little bit when he was talking about idiosyncratic advantages to some of the deals this fund has. Tax credits, he just mentioned, which is essentially free equity or the lack of paying property taxes for a given period of time. You'll find this again and again and again in the deals we're in, whether it's this fund or other funds, but we're trying to hedge the macro that we can't control. And one of the things that we can't control is in the common equity, in the first loss position of real estate, it takes a long time for it to reprice. And that's what I was trying to say when I was mentioning K-Series. K-Series is publicly traded. It's an interbank publicly traded security. We have access to that market. There's not many firms in the world that do. We do. That is seeing dislocation already. And because it's publicly traded, it's going to react like the stock market. That's the opportunity today. Common equity, that opportunity probably will be in 12 months, 18 months, as the things that we're seeing cascade through and eventually a new equilibrium is reached with pricing. And we'll be there. Believe me, we'll buy plenty of common equity deals. It's just too early. It's too early. And by the way, if I'm wrong, then there's asymmetric risk. Why take it, right? Why would you buy at today's pricing in first loss when it really hasn't repriced? You know, it's just common sense. And so how does that relate to the second question, which is what are the expected returns on a Blackstone BREIT? They buy first loss positions. They did a lot of acquisitions at last year's pricing. And by the way, I think very highly of Blackstone. I think they run a very good business, and it's a fine investment. But I do think that they raise so much money that there's just a lot of I don't know what is going on, but is that your computer or mine, Dave?
I don't think it's mine.
It's
So I'll go on
interesting.
mute.
I think my microphone is talking to me, which is very distracting. So I apologize. But my point is Blackstone raises so much money that there's real pressure to put it out. And I think that, you know, a lot of money was invested at pricing that is going to be tough to deal with going forward for their fund. Short answer, we're very patient and we're stewards of your capital. This fund has done nothing but protect and grow your capital. We're going to be in pref until the common equity side starts to reprice, and we believe it will. And we also believe in multifamily as a long-term asset, and we'll, you know, it's going to do just fine in 5, 10 years, et cetera. But I think that there's a high probability of a reprice. I don't want to be in first loss right now. I think the funds that are will see significant underperformance relative to us. Go ahead, Dave.
Yeah, so the anonymous question, how long will Origin IncomePlus Fund generate depreciation that shields all or most of the distributions? And we did cover this a little bit in the last webinar. The short answer is perpetually. As we continue to hold our common equity portfolio, we walk through how the depreciation benefits from those individual assets actually help shield almost the entire amount of the distributions. And as we convert our build to core portfolio into operating assets, the size of the common equity, and this is actually another question from someone, is why not incorporate more common equity into IncomePlus Fund? We will, and we have, by virtue of our build to core assets. So as those assets become operational, and we can, from an accounting standpoint, take depreciation, the amount of depreciation shield that we will have available will continue to grow. So that is certainly a fundamental element of this portfolio, is making sure that we are generating efficient, tax efficient distributions.
All right, we have a question about K-Series, since I've mentioned it a couple times. The question is, does IncomePlus plan to invest in K-Series? We're not sure. It can. It has the capability of doing it. It's an approved investment of IncomePlus. So we're evaluating it and also looking at it relative to the opportunities in preferred equity. But in general, we're looking at protected investments. In the case of K-Series, you have 40% equity subordination, which we're very interested in this environment. But maybe you can make on a current pay bond, you can make about 10% unlevered right now. So that's interesting. If you can make 10% and have 40% protection, that's interesting. We're taking a look at it for this fund as well, but we'll look at it in relation to other opportunities that are also protected. So that's the answer there. There's another question about a sidecar opportunity, because I think Michael, hold on, I figured this out. This is my phone. It's Siri
talking to you.
This is Siri. Siri thinks I'm talking to her. That's hilarious. Note to self, don't have your cell phone in a webinar. That's funny. Okay, so I think Michael might have mentioned a sidecar. If we have a sidecar, most likely it'll be a preferred equity opportunity at today's rates. And Dave mentioned that, we're getting much more protection now as well. And I was actually, I was talking to Tom Briney this morning. There might be an interesting sidecar opportunity with our partner Rise in Florida, a deal in Florida. We've done, my God, I think we've done probably 7 deals with Rise now. They're a tremendous company. So this could be something that we bring out in Q4. But if we do, obviously the IncomePlus Fund investors will be the first ones who see this opportunity, because preferred equity goes into this fund. So you will be given priority on the investment if you have interest. And then of course, we'll open it up to other investors if it's not completely filled. So more to come on that, if in fact we do it.
Dave, I think you answered Christopher's question on K-Series, but his question was, or maybe more of a just pointing this out that some folks may interpret the B piece being a first loss, and it is, but it's got a large cushion because of all the equity that sits in front of it. I think you just highlighted that at 40%. So thank you for pointing that out, Christopher. So we'll move on to another question. The question here is, will the focus still be on development? Some funds have been acquiring distressed assets that operators need to sell because they can't make debt service. So assets are acquired at a huge discount. Will you consider any of these opportunistic plays? Great question. Short answer is yes, we will. But right now we have not. I mean, there may be a one-off situation where you've seen some pricing discount. But we're not seeing that yet. We believe it's coming. Dave hinted at this or discussed this previously. We're in a slow moving market, and it takes a while for asset values to unwind. Oftentimes you have lenders who are willing to work with you or rescue equity. So we're not seeing fire sale opportunities right now. We are certainly keeping the pulse on that market, and we will certainly look at those when they make sense. But we're still, we believe, we're off maybe 5 to 8% on the highs, and we think there's maybe more to come. So we'll definitely look at those opportunities become available, but we're not seeing those yet. And if you want to look at where do we think we're going to see most of the opportunity set lie, Dave talked about this previously. It's going to be in the value add space, likely 80s, 70s, even 60s vintage product that was acquired at the peak in the last 12 months using short-term high floating rate bridge debt. And in 2 years, if rents continue to go negative and those are levered at 70-75%, that's where you're going to see the most dislocation. So we'll continue to monitor those.
And by the way, everyone, send us your feedback. You can do it in the chat, or you can email me, david@origininvestments.com. Or if you have a question, you can email me that question. I'll answer it, or I'll send it on to our team. I was remiss in not saying that earlier. david@origininvestments.com. You can always contact me directly. Feedback or questions are welcome. We're in this with you. This will be a long-term fund. It's open-ended. You're going to do incredibly well in this fund. I remember in COVID, my partner Michael and I each invested $1 million each in this fund in April of 2020. So right after COVID hit, the world shut down. And it was an uncertain time. And what wound up happening is the fund did really, really well. And it'll continue to do that. This fund is set up to win, and to win in the long term. And so I would encourage everyone to view it as such. Everything doesn't just go to the sky in a linear fashion. You don't just take a slope and say, okay, it's up 1% a year forever. If you're in a fund like that, you should also try to get out, because that's manipulation and that's not honesty. But over a 2-year period, 5-year period, 10-year period, you're going to be really happy you're in this fund. It's going to be tax efficient, and it's going to be steady growth the right way. We're in the right asset class with the right management team. I feel very confident about that. And candidly, I write with my checkbook. Like, I'm in it with you in a big way. And I'm very pleased to be in it with you. Okay, that's it, Dave. Why don't you send us off, because I want to put you on the spot.
Well, I appreciate you all joining. Great to be with you again, Dave. And I look forward to virtually kicking your butt in the playoffs. So, see y'all.
All right. See you.